Today we are going to talk about trading terminology. If you are interested in trading, it's essential to understand some basic terms that will help you to navigate the market and understand the market very confidentially, and it simplify the explanation of key concepts. So by going to the slide, we will learn some terms today that will help us to understand the basics of this market, the financial market. So first of all, you can see here in this picture, there are sell and buy. Sell and buy means ask and bid price. The prices which assets are bought and sold. This is very simple. So the selling price is 12604. The buying price is 12602. So even though if you are going to an exchange and you have USD dollar, you want to exchange that to euro. So if you are giving the teller, which the exchange company, your USD, he will give you back euros, right? But at the same time, if you are going back and giving him the euro back and receiving dollars, you will see the difference in the price, correct? That's what we call it spread. The difference between bid and ask price. It's reflect the cost of execution the trade. So this cost, the difference between buying and selling or between bid and ask, this is the cost which the trading company or the trading platform takes from you in order to execute your trade in real market. So some platform they take very big spreads, and some platform they take small spreads. It depends. Some platforms they said, okay, we are offering you a very good service. We are offering you like a strong support team, a very strong platform. So we will take higher spreads. I hope you understand the point. So this it's very important to know how to calculate the spread. In the next slides, I will show you in details, or even if we are going to the practical, I will show you how to calculate the spreads and from where you can know how much is the spread. The third part is the PEP. The PEP is the smallest price movement in the market or in the currency exchange. The pips counts the digit that the price moves up and down. So we count it by pip. We call it pip. Pip means percentage in point. So each movement in the market is calculated by pip. So for example, in this picture, you can see the selling price is 12604 and the buying price is 12602. So if the price moved from 2 to 4, means the price move 2 pips. Understand? That's why we calculate the pips, and it's very important point to understand because it's all about pips in our trading. Sometimes in the news you can see like the channel they talk, they say the gold price moved up 500 pips. So why they calculate it by pips? I will explain for you now why it's very important to understand the pips. So as I said, it's the smallest price movement of any currency. So we calculate it by pip. Each pip count for us as traders. Why? Here we come to the lot size. The smallest unit that we measure for trade size. And we have three main types of lot size. We have micro lot size, which is 0.01. That means equal to 1,000 units of that asset. For example, if I'm buying euro with 0.01 lot size, means micro lot size, it means I am buying 1,000 units from that asset, from euro dollar asset. If I am buying 0.1, means that we call it mini lot size. 0.1 is mini lot size. It means I am buying 10,000 units from that asset. Maybe it might be a gold or euro dollar or Japanese yen, whatever coin, whatever asset is it. I'm setting 0.1 means it's equal to 10,000 units from that asset. If I'm buying one lot, 1.00, that's we call it the standard lot size. It's equal to 100 units from the currency base or from the base currency. From here, what we understand? So if I set my lot size 0.01, so and the price moved 1 pip up, means I'm winning or losing 1 cent, right? And if I'm setting mini lot size 0.1 and the price moved 1 pip, mean I will win or lose $1. Understood? And if I'm buying one standard lot 1.00, means if the price moved by 1 pip up or down, I will be winning or losing $10. So from here, what we understand, the larger the lot size, the greater the value of the pip. So if I set a large lot size, 1 lot or 2 lot or 5 lots, means my capital should be very big, huge capital. So if the asset reverse or the price reverse against me, I can manage the losses. You understand? That what we call it money management. Here it comes the money management part. I will explain in details in the money management part. But for now, I want you to understand the pip size, how we set the lot size according to the pip. So our pip value is how much we set as lot size. The larger the lot size, the greater the value of the pip. Understood? Okay. The next part is leverage, the scale. It's amplify both profits and losses. Let me make it simple for you guys. It's a loan that platforms give you to increase your ability to open more stronger trade, stronger lot size. And it's good and it's bad at the same time. It's bad if you have a small capital and you open big lot size. Then you will lose your money very fast. It's good if you have a reasonable capital and you want to open bigger lot size because you're confident that this level of the price you can buy or sell and make profit. So you can amplify your profit more. So for example, if we say my leverage is 1 to 100, means $1 equal to 100. Understood? And $100 equal to 10,000. It's not by number showing, no, it's by the value of your 100. If you choose your leverage to be 1 to 100, sometimes there is 1 to 1,000 leverage. It's very risky to have a 1 to 1,000 leverage, but some people, experienced traders, they use 1 to 1,000 or even 1 to 2,000, 1 to 5,000. You can go up to unlimited. Some platforms, they give you the ability to have an open leverage, but this is so risky. So the leverage, it's very important to use it in a smart way so you will not lose your money. Even this, I will explain it in the practical course. So now I want you just to understand the terms and what's the meaning of the term. And we have the profit, means the method that calculates your profit. We call it take profit. And we have the stop loss, a tool to use to limit your losses. You can set levels that the price, if it's reached, you will exit from that level with losses. That will help to manage your capital very well, and you will be in the safe side. All these things I will explain it later on in the practical course. So the next part will go to types of market analysis. And this is a very important part for you if you are planning to become a trader. Types of market. Trading is simple. As I told you, it's a buying and selling assets online by using platform. So how I will buy or why I will buy or sell. There are two types of analysis, of market analysis we can do. Then we can decide to buy or sell the specific asset. First one, we call it fundamental analysis. It's focused on economic and political and financial factors to estimate market trend. So if I want to know the trend of gold, for example, by using fundamental analysis, I will be watching TVs, news, governments, what they are saying, Trump, and all these things, what's happening in the world. That's what we call it fundamental analysis. Then the second one is technical analysis, which we are using mostly in our trading. Technical analysis focused on historical price data and chart pattern to predict the future price movement. So there we always look at the chart and read the chart in a certain way that will help us to understand the price from where it came, where it ended up, where the price is now, which level is it. By reading and understanding the chart and the market, from there we can draw some. The chart will show you some patterns. There are some indicators you can use. There are some school of analysis that you can use also to analyze the market. Then only you decide to buy or sell. Right? So we have technical analysis. As I told you, we will concentrate on technical analysis because it's best way to trade, and you can add fundamental analysis as well, but it's better to use both and mostly technical analysis. There are so many schools in technical analysis, using technical analysis, sorry. First one, we call it classical analysis. The second one, Japanese candle skills. We have technical indicators. We have Elliott waves. We have harmonic. We have SMCs. We have a lot of schools that will teach us different ways of analyzing the market. But in the beginning, there is something you need to concentrate on because all this school depend on it, which is Japanese candlestick analysis, the key technical analysis tool. By the way, we can use Japanese. This is the main thing we need to understand. By this, we will understand the behavior and liquidity, the price behavior and liquidity, the support and resistance level, the trends. Technical indicators will also help us to analyze the market. So, why I'm concentrating on Japanese candlestick? Because it's your first vision in the market. The first thing you will see when you are opening the chart is Japanese candlestick. That's why I will explain them today in detail so you guys will come to know how to read the candlestick. So Japanese candlesticks are visual representation of price movement over a specific time period. This is the simple definition. So each candle, as we can see green candle and we can see red candle. The green candle means the price is moving up, and the red candle means the price is moving down. And this is a single candlestick display. Each candle have 4 elements, and we need to understand these 4 elements: the high, the close, the closing again, and the low. So sorry, a close and open. I will repeat it. The high, the highest point that the price reached, and the opening price. This is open. This is by mistake. It's written. The price opened from here, and the closing price and the lowest price that the market reached. So the high means the highest price reached by the market. So the market reached till this point, but it didn't close here. It closed here. Why it's closed down? Because the candle is red. If the closing price was up, means the candle closed green, means the price was moving up. So we have also this small line, we call it wick, and this one here in the middle we call it the body of the candle. So we have 2 wicks and body of the candle, and we have the highest point that the price reached, and we have the opening price, and we have the closing price and the lowest price reached by market. So far, I want you to understand the elements of the candle. These are the elements of the candle. Okay, so these are some types of candlesticks. We have the simple candlesticks, which contain only one candle, and we have multiple candlestick pattern, contain 2 or 3 or 4 sometimes candles. What does it mean? How these candles are helping me in analyzing the market? For example, we will take hammer candlestick. Why we call it hammer? Because it's shaped like hammer. So, if the price was coming down candle by candle by candle, and all of them were red, then suddenly I see a rejection candle, and it's a pin bar. What's happened here? The price moved down, so at the last moment, because it closed before closing the candle, the price moved up and the candle become green. We call this a rejection candle, hammer. Then from this price, we will wait for the next candle to break the high of the price or the high of this candle. Then we enter buy order here. We will buy this asset in order to the price because I expect the price to move up. Then I will exit from some levels here with the profits. So this is how we understand and we can read the candles. As we can see here, I will explain them again. The highest point that the candle reach, the shadow, the upper shadow, or and the lower shadow, or the upper wick and the lower wick, the body of the candle, the opening price, the closing price. Why the opening price is here? Because the candle closed green. So the opening price that means the candle is moving up. So the opening price is here and the closing price is here up. At the opposite way, it's for the red candle. The highest point, the lowest point, the upper shadow, the lower shadow, or upper wick, lower wick, then the body. And this is the opening price of the candle, and this is the closing price. Right? We have those so many candlestick patterns that will allow us and different names. All these things I will send you guys. Just contact me. I will send you and I will set one session only for explaining the way the candlestick patterns and the meaning of candlestick patterns and how many types of candlestick patterns we have. I will explain all in details. For now, I want you to understand the elements of the candle, of the bullish candle and bearish candle. Bullish mean up, bull. Bearish mean bears. They push the price down. The bull, the buyers, they push the price up. So that's how it become red or green. All right, as we can see here, the theory of the price action or candlestick pattern, they gave, as I said, we have single candlestick patterns, doji or hammer. This we call it doji. Long wick, up and down, and small body. We call it doji. We have hammer here as well, as I explained for you. And we have multiple candlesticks example, engulfing, because this small candlestick got engulfed by the big candle, the green one. So means the sellers became weak after coming down. So after price coming down for so much time, the sellers became weak. Then the buyers took the control of the market, and this candle showed. Then what I have an engulfing that indicate that the price might go up. This is a first confirmation. Before entering the trade, we need to take different or multiple confirmations before opening any trade. So first thing we need to understand, as I told you guys, is candlesticks pattern, because this is our first confirmation, our first price action, our first vision in the market. As example here, we can see a live chart, a picture of the chart. It will look like this. Price coming down, different shapes of candles, price going up and down again, up and down. So where I will buy and where I will sell. As we can see here, a strong movement down. As I told you, price is moving down very strongly. Then suddenly, this pin bar is showed. Then it gave me a rejection candle, pin bar candle or hammer candle. Hammer means pin bar. We call it as pin bar as well. So what I will do when I see this, it will give me a vision that the price might go up. Why? Because rejection candle came. And if it's come in support and resistance level or any level, then it will give me second confirmation and the stronger confirmation. So this is how the candlesticks are strong. Then I will buy from here. I will take the price all the way up. Then where I will exit? When I see a reversal candle, then only I will decide exit and open selling trade. This is just an example I'm giving you guys. The market will never move like this, like as you can see or as you wish. No, 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 no. There are a lot of complications and a lot of confirmations you need to take before entering any trade. So I want you to understand now the importance of candlesticks and the price action.